Like in the morning, we get more illiquid, and then in the afternoon, it starts reverting back. So, this is kind of a delicate balancing act at this point. But this is about when they first started to tap the prime borrow rate in order to reverse, I guess, the mean reversion. To reverse the mean reversion of liquidity, they started to borrow actual shares of GameStop. They've been doing that, but there's not very many of them available, hence the rapid increase in borrow rate. I don't know how long this can last for, but I'd imagine they can't keep it up for very long. Unless they're shorting on Cialis. In which case we could be here all week. Upstart? Upstart widened out again? I guess by the time the candle closed? Here, I'll show you. It looked like it was snapping closed this morning, in the pre-market, but no. We want this. We want liquidity to go. Well, we want liquidity. So we want the green to go down and the orange to go up. Like we experienced back here in August. See that? See how the orange, but Upstart is far more illiquid now than it's been since, well, it was like $200. If we go out here on the daily, we can kind of get an idea. We're about as illiquid as we were in early November on Upstart. I actually think it's hit the tipping point. They're just delaying it. Like I think mean reversion should have already occurred in the liquidity on GME, especially. But they've reversed the trend by moving into the borrowing pool, which I think we saw them do. Actually, if we want to dig in a little deeper here and fuck around with this, I think we saw them do a similar thing before the May run. This is when borrow rate started to spike the hardest in May, right? And then it continued to spike through most of this run. And I think that this served two purposes. I think they didn't want it to run out of control, so they continued to borrow into the rising price action, right? And I think they tried to stop the breakout in price action. And so, we started to get a reversion in liquidity here, which, would have been realized immediately, but then they were able to offset it a few days by kind of hitting the borrowing pool really hard, right? And then, in May we ran really late into the OPEX period. We ran on like Wednesday, which was unusual at the time. But now, I mean, it's like they're really fucking struggling. Because even if you look at like January, like or June and July, like those OPEXs where we ran a little bit, like we had fairly significant reversions in the liquidity on GME here too in August for August OPEX, which occurred a bit early. And then with September's ETF FTDs, we see IJH and XRT get a nice little liquidity bump, and GME gets a small one, not as big as the OPEX, right? But then they start driving the illiquidity up. October 31st comes around, we get a little liquidity, but not nearly as much as we got in the previous runs, right? If we look at these levels. And then, immediately it starts getting more and more illiquid again, to a point where we hit a peak even higher than March. And then that starts to mean revert, and then they've turned that around right when the borrow rate spikes. So I don't know how much they can push this back. But and eventually this is going to need to either realize, like levels like March, where we get like almost like a full reset in liquidity, or at least, May, where we get a significant increase in liquidity. And this is, this has been true all the way through, with, even in like December and January of this of last year, we got some liquidity. Like they ran the stock a bit, not a lot, but if they don't blow off some steam, it just builds a bigger and bigger event, if you will. And so you see this with, if you look at, like this is December, Jan, Feb, right, leading into March OPEX. See how they don't really restore a very sufficient amount of liquidity? Like enough to keep going, but not a lot, right? And then, eventually we get like the big liquidity event that was March. And we're looking at something similar to that now, but we already had so much of it here, right? We haven't had like a good release of liquidity in so long. Like even this was minimal compared to March. And close enough on the heels of March that maybe it only needed to be minimal. But since then, we've had no significant resolutions of liquidity. And then this is awful. Like this little blip we got right here, that's nothing. That's not going to last them very long at all. I mean, the split doesn't really change that. What if Jimmy runs late and runs in late Jan again, like in 2021? Would that mean some sort of 2-year swap being used or something? No, not really. So like that reversion in liquidity, it's necessary for them to continue to not only have a market in which some efficiency is present, but a market in which their positions can continue to be hedged. They're short vol, but they're reliant on the market maker. And if the market maker runs into a market that is so illiquid they can no longer hedge, that's going to create a massive amount of risk and it's going to blow up positions, right? So they don't want that. They want to sustain some level of liquidity while driving implied volatility down, right? And to do that continuously over time, eventually you need big liquidity resets. So not only can they get IV really high to short it once again, right? But so the market maker can re-hedge efficiently. That's why that break of gamma max is so important. If Jamie runs 1,000%, then maybe there was a swap somewhere that couldn't be rolled. Sure. Hey, don't get me wrong. I'm sure there's a lot of hedging and like variance swaps and entropy swaps and volatility swaps that go into all of this. But I mean, without the ability to reverse engineer those swaps and the options chain, they're kind of irrelevant. Did anybody follow the flowchart about buying 38.35 puts when we're above 38.35? I'm just asking for a concerned friend. Now you guys are understanding how this market works. Look at you. Well, no, because it's almost a perfect position, right? In building their short volatility and short positions, they build up obligations that once realized at a much lower price will recreate a highly volatile liquid environment in which they can then short again, right? So the act of pushing the price down and driving volatility down results in the price going up and volatility going up. It's not a perpetual motion machine, right? But it's like the most perfect position ever. Because simply by withdrawing their short position, they create an effect where the price of the underlying goes up massively, right? At little to no cost. And then they get a short all over again. So the root cause of the run to 480 was trying to suppress a necessary liquidity event. No. The liquidity events were part of the run to 480 in January. But what actually happened is they ran out of liquidity. They did not sufficiently maintain an environment liquid enough to propagate the continuation of their positioning. And that wasn't really their fault. That was because Ryan Cohen came in and bought a significant amount of shares twice, and retail then, significantly leveraged the market maker to the upside. And then, it was on Reg Show and it was failing its fail to volume ratio was very high, which, creates an inability to find locates effectively, which means you get a higher and higher fail rate, and then eventually you end up in a situation where you need to short into your own covering of your previous failures. So you're covering your old short position while shorting to maintain the price on the stock, and that breaks, right? You can't do that. Because, at that point, when you're that deep into Reg Show, and this is something we're watching on Upstart, and I'm continuing to watch on Upstart because I think it'll happen again. But they're failing so much that, they're then covering fails, and then the shorts they use to maintain the price while covering their fails are also failing, and the volume they're generating to cover those fails is failing, right? And so you get like a runaway failure effect in the stock, right? And that's a large part of what led to January's run up. Because as that effect began to break down and, failures simply just needed to be covered, that started to drive price and volatility up, which then put short volatility positions and long short positions on the stock in a significant degree of risk, and that then forced their covering, and then the short volatility positions started hedging, and that's what led to the Volga-Vana squeeze. Don't look now, but Upstart is Moana-ing. No, Upstart is up 10 cents. And Citadel got to affect their position, and they still do, all over the market, right? Until pesky retail came along and almost blew one of them up. But why do you think Citadel gave Melvin money? Right? Because Citadel had far more risk with their short volatility positioning than Melvin had with their actual short. Like, they just fucking bailed him out, right? So that Citadel wouldn't blow up. But we've discussed, especially on Upstart, how these short volatility positions are not in line with long short positions, right? Because of the blow off valve nature of the short volatility positions, that puts long shorts at risk too, right? Now, not only does it slowly grind long-term shareholders out of the underlying, but the upside moves can grind short-term long short positions out, right? GME is dropping from $50 in August, down to $18 now, right? And short positions that came in here on GME between like 25 and 18, they're really profitable right now. But that short volatility blow off is going to happen, and that's going to drive the stock back up, and that's going to force out these long short positions because they're going to be massively underwater, right? Now, the long short positions that started here, they're going to be fine. But the ones nearer to that release of energy, if you will, they're fucked. Right. And so these positions aren't really aligned. And so what's interesting about Upstart is that, you had people shorting from like 400 all the way down to its current price at $13, right? And a lot of these are long short positions, and some of them, well, not even just some of them, a lot of them have come in recently, right? They're not short from 400. They're short from like 40. And these positions are significantly at risk of a large upside move, right? And if they start capitulating, then you're going to get more upside, right? And so, as these shorts blow off and get buried, they're gonna close their positioning, and that's going to drive price action even higher, right? And that's what's so enticing about finding a position where you have a company that's not going bankrupt, is over short on the over long short, and also shorted via these volatility positions. Sure, but if they roll their positions down, Gerald, and increase their leverage, they're in even more trouble if the price of the underlying runs. Look at Bobby. Look at what the shorts did on Bobby, right? That was a really brutal and unrefined short position, right? They just kept rolling their short down, increasing leverage and pressing the price down further and further. And the whole time, longs took advantage of that by using the cheaper cost of calls to increase their out of the money call leverage, right? And so the second the shorts gave an inch on Bobby, the whole fucking thing blew up. Fast too. Well, because when you take profits as a short, you drive the price up, right? So if you have a big short position, it's not easy to exit it. You can't just go, okay, I'm going to buy all these shares, I'm done, I'm out, right? You have to pull out slowly. And the thing about the short vol positions is it forces them to pull out quickly, and they don't like that. So if you want to know who would fight back against a run, long shorts. Long shorts don't want it to run. They want it to go down. That's what they paid for. Yeah, I'll just make that the whole fucking... I'll just clip the whole thing.